Well, good morning. Jaginder Rana here. The topic of the day is tax benefit on insurance policies. Tax benefit on insurance policies. See, insurance policies in India serve a dual purpose, providing financial security and offering significant tax benefits. So, under the Income Tax Act 1961, policyholders can take advantage of various tax saving opportunities. These include tax deductions on premiums paid with up to rupees 15 lakh, 1.5 lakh, up to rupees 1.5 lakh, annually deductible under Section 80C, and tax exemptions on policy proceeds under Section 10D or other 10D. So the tax benefits extends further through additional provisions in Section 80D, 80CCC and 80CCE. So this comprehensive guide explores the multifaceted aspects of life insurance tax benefits, detailing eligibility criteria, TDS regulations, GST implications, and tax advantages at different policy stages, including those associated with policy riders. So, you might know you can save tax by investing in life insurance policies. And life insurance is a vital element of financial planning. It offers death and maturity benefits to the nominee or the policyholders. So, in the case of untimely death, life insurance offers financial support to the policyholders' family members. Now, life insurance policies in India allow individuals or policyholders to save taxes by investing in life insurance policies under the Income Tax Act 1961. So, these tax benefits allow individuals to save taxes along with getting financial security for themselves. These benefits can be categorized into deductions and exemptions. So while both help you reduce your tax liability, they have their own applicability. The Income Tax Act allows policyholders to save tax by reducing expenses, investments from their gross total income. The life or term insurance premiums paid are eligible for tax deductions under Section 80C. A maximum of 1.5 lakh can be saved each year as per the Income Tax Act 1961. So these benefits include premium paid for policy bought for a spouse or children. This is a part of your income that is not subject to tax and can be excluded from your total income. Tax exemptions are applicable to payouts or proceeds from the policy. They fall under Section 10D of the Income Tax Act. You can save income tax by buying a life insurance policy at various stages of the plan. And also on the health insurance policies, this tax exemption is available. So you are eligible for tax deductions under section 80C, 80CCC and 80D of the Income Tax Act. Section 80C is for life insurance, 80CCC is for pension plans, and 80D is for health insurance. Your investment in the life insurance policy will grow over time and is tax-free, subject to conditions. Let's say you want to make a switch between different investments. So these switches can be across equity, debt, or other funds and are not currently taxable. So the payouts of proceeds from the policy are eligible for tax exemptions under section 10(10)(d) of the Income Tax Act 1961. However, there are certain terms and conditions you might know and follow. So section 80C allows policyholders to reduce their tax liability by paying premiums towards the life insurance policy, for which a maximum deduction can be claimed up to rupees 1.5 lakh a year. Section 80D allows individuals to save taxes on making premium payments towards health insurance plans. This is also applicable to policies taken for spouses, children, or parents. So the maximum tax benefit is up to rupees 25,000 a year. It can rise to rupees 1 lakh if the insured and his parents is above 60 years of age. Also, rupees 5,000 worth of tax deductions can be claimed. Also, 5,000 worth of tax deduction can be claimed for yearly preventive health care, such as health checkups subject to above threshold limit. Section 10(10)(d) exempts you from paying taxes on the proceeds or payouts upon the maturity of the policy. It is usually applicable to all proceeds from life insurance policies, be it from death or maturity benefits, provided the policy satisfies the conditions laid down in the section. Then section 80CCC allows policyholders to be eligible for tax deductions upon payment of policy premiums towards specified retirement or pension plans. So the maximum deduction is applicable for 1.5 lakh. $1.5 lakh a year. In case the policyholder surrenders the pension plan, the amount received on surrender shall be taxable as his income if the deductions was claimed under this section. Section 10(10)(a), as per this section, a committed pension which is received in a lump sum is fully exempted from tax for government employees or from pension funds of life insurance companies. Uncommitted or monthly pensions are fully taxable and are not exempted from tax. Section 80CCE. This section limits the maximum deduction under Section 80C, 80CCC and Section 80CCD1 to rupees 1.5 lakh per financial year. Now, riders and add-ons to a policy that are chosen to enhance the coverage of any policy, but more offering enhanced protection. They also come with tax benefits. A few benefits are like this. Section 80D allows you to get a tax deduction on health insurance premium paid if you opt for a critical illness rider with your health insurance plans. The maximum deduction can be up to rupees 25,000 per year. It can rise to rupees 1 lakh per year for senior citizens, taxpayers, or her parents. So if you choose the option of return of a premium rider along with your policy, your premium amount rises. This further allows you to avail more tax benefits under Section 80C of the Income Tax Act. Now, riders do not only enhance the policy's coverage but also make you eligible for additional tax benefits. Hence, it offers the dual benefits of increased protection and tax savings. For exact information, you must read your policy documents and carefully review the terms and conditions. Now, what is TDS on life insurance policy? The TDS to be levied on a life insurance policy is as follows. From October 2014, it has been declared that in case of payouts above rupees 1 lakh from a life insurance plan that is not exempted from tax under Section 1010D, the insurance company is bound to deduct 1% TDS while making payments or transferring proceeds, including any bonuses. So if the proceeds you receive do not exceed rupees 1 lakh, the TDS won't be deducted. However, the income received shall be fully taxable. The TDS claim can be availed of while filing income tax returns. On any life insurance policy payout paid on or after 1st October 2019, TDS deducted shall be 5% of the net proceed payouts less premium paid or income from the policy as stated in the Union Budget of 2019. So there are some exemptions to the TDS deductions under the Section 194DA. Some of these are as follows. If the amount is received under Section 80DD3 or 80DDA3, the policy was brought between 1st April 2003 to 31st March 2012. Premium paid against life insurance does not exceed 20% of the total sum assured. The policy was brought after 1st April 2012 and the premium amount paid to the insurance company doesn't exceed 10% of the sum assured. In other words, no TDS is deducted if the life insurance policy falls under the purview of Section 1010D, and TDS deduction is attracted only in case of the life insurance policy. Payouts and hence pension, annuity and other types of payouts are outside its scope. So before the introduction of GST, policyholders had to pay a 15% service tax that included the basic service tax, Swachh Bharat cess and Krishi Kalyan cess. After implementing GST, a uniform GST rate of 18% on the term insurance premium is charged. In case of rest of the product, insurance company is given an option to charge GST at the rates mentioned in GST law. So eligibility criteria to claim life insurance tax benefits is deductions and exemptions to save taxes legally can be opted by Hindu undivided families and individuals. These can be claimed on the premium amounts paid and on the receipt of maturity proceeds or any other income from policy. These deductions and expenses help to reduce the overall tax liability of policyholders. So these benefits can be availed of for self, spouse, parents, and children. So the main idea behind this is to inform you that the tax benefits available for buying a life insurance policy and health insurance policy for yourself and your loved ones. However, you must note that you should not buy a certain policy just because it offers lucrative tax saving options. You must be clear with your goals, affordability, personal aspects, income, etc. before making a purchase. So it is advised to compare different policies, go through the terms and conditions, and ask as many questions possible before making decisions. So the premium for the policy are eligible for tax deductions from the total taxable income of the insured. The maximum income tax deductions that can be availed of is rupees 1.5 lakh a year under Section 80C. It will depend if the premium that you paid for a life insurance policy is less than 10% of the total sum assured and the policy was issued after 1st April 2010, then the amount received on maturity or surrender or death is completely tax exempt under Section 1010D of the Income Tax Act. Moreover, for life insurance policies issued before 1st April 2012, if the premium that was paid does not exceed 20% of the total sum assured, then any amount received is completely tax exempt. You can invest up to rupees 1.5 lakh towards the ULIP premium payment a year to avail yourself a tax benefit under Section 80C of the Income Tax Act. So ULIP is an attractive investment because it allows you to save taxes in two ways. First, the premium payments are eligible for tax deduction under Section 80C of the Income Tax Act, and then proceeds or payouts are eligible for tax exemption under Section 10DD if the policy satisfies the conditions laid down in Section 10DD. But to evaluate how effective a tax-free instrument is, you must focus on its liquidity, safety, return on investment, convertibility, accessibility, cost, etc., along with tax savings. So this financial plan necessitates effective tax saving strategies. If you find yourself bewildered by the array of tax saving investment options, turning to insurance can serve the dual purpose of securing your financial future and obtaining tax savings. So the term life insurance is an excellent choice for those in search of a straightforward life coverage without the intricacies of investment-linked schemes. Such plans provide substantial death benefits at comparatively affordable premiums when compared to other types of life insurance. So on almost all kind of life insurance plans, the tax exemption provisions are there, because the maturity benefit derived from a ULIP is exempt from tax under Section 1010D of the Income Tax Act, provided that the annual premium paid does not surpass rupees 2.5 lakh. It is crucial to keep this in mind, as exceeding this limit can subject the taxation returns. Similarly, securing a health insurance policy is crucial for safeguarding your financial well-being and ensuring access to adequate medical care in the event of illness. But similar to life insurance, health insurance policies provide substantial tax advantages under a distinct section of the Income Tax Act, that is Section 80D. Thank you very much.